Welcome back to Morning Trade Live. Let's talk about the macro picture. Joining us now for some insight is Keith Buchanan, Portfolio Manager of Global Investments. All right, Keith, thanks so much for joining us this morning. So let's talk about the big picture here. We had a week that was heavily focused last week on NVIDIA, depending on who you're talking to. But now it seems like the picture is going to widen out this week. So what should investors be paying attention to in terms of the course of the market this week?
Thanks for having me. The course of the market this week is, as you mentioned, the pivot away from NVIDIA. It's not just that most people were talking about. Everyone was talking about NVIDIA, the market cap that it garners now, how big of a shift it was, and just the AI momentum right now behind some names in the marketplace. The shift this week will broaden out, and that's kind of a microcosm of what we see going forward for the rest of the year is just more attention paid to other spaces in the market. And we'll see that with some economic readouts. The story will remain the same. What will inflation continue to develop into, and how will growth be affected by that, and how will the Federal Reserve have to react? And that will dictate a lot of the movements across the market space. AI has kind of been its own animal, but we're really in touch with what's going on with the broader economy and the real economy on the ground.
And Keith, I want to ask you, what other catalysts do you see this week besides, obviously a lot of attention is being paid this week to PCE. What other catalysts or what are you looking forward to hear from, say, Fed speakers this week?
We still see a gap. The gap coming into the year was the market expected somewhere around 6 to 7 rate cuts this year. That's been cut in half to now 3 to 4. The Federal Reserve, at its last economic projections, forecasted 2 to 3, so that gap is narrowed. But we want to see if Federal Reserve speakers will continue to speak to the marketplace as far as keeping their options open. Not only the options open of staying pat for longer, keeping rates at higher for longer, and further into 2024 than the market currently anticipates, but also having the notion that they could potentially even have to hike later in the year, or there's a hike potentially before more cuts later in the year. So the optionality that these Federal Reserve speakers put into the marketplace is extremely important right now. And I think the market will be hanging on to every word that comes from these speakers to try to justify their positions and expectations on rates going forward for the rest of the year.
Is the market price right if the idea of 6 to 7 rate cuts has been basically taken off the table?
So if you take 6 to 7 rate cuts off of the table, the notion that longer term, higher duration assets will outperform probably wouldn't be the case. The AI revolution has completely turned that traditional way of thinking on its head. So growth has outperformed value. Large has outperformed small, which is somewhat opposite of what you think if the market is anticipating a less restrictive Fed coming up this year. Maybe not so much as it was early in the year, but now that that's changed, we've seen kind of the opposite of reaction within the marketplace. So the market is starting to adjust. AI, again, has changed the equation where it's not just about monetary policy. So we're still, now we're out of earnings season, the refocus will again shift back to what the market expects for the broader economy. We think some of those will come in clearer focus over the next couple of weeks. And then we'll see how the market has reacted and if it's properly positioned going forward.
And then, Keith, you mentioned AI, and earlier we kind of set this up talking about how last week really the catalyst and focus was NVIDIA. When you think about opportunities outside of AI and, say, the Mag 7, where are you seeing opportunities in non-AI growth?
We see several opportunities outside of non-AI growth, not only from a valuation standpoint, but some of these names have already started to really perform well. It's just not to the degree of some of the Magnificent Seven, and it just doesn't have the sex appeal. And almost one of the opposites of what we're seeing with AI is a name like Waste Management. They just continue to execute. They have some inflation riders that are really contributing well to margins as inflation comes down, but their prices haven't yet. So Waste Management is a name that we're really excited about, and we started to see that name perform very, very well in the recent past. Another one is Walmart, as mentioned earlier. But Walmart is a name that just continues to change its stripes, if you will, to become more like Amazon than Walmart of 30 years ago. The Vizio acquisition is a perfect example of that. It's not just about the hardware. They really want to be able to push advertising to its customer base, get a lot more savvy about who's coming in the door, and make sure that those customers that are ordering their products, get them delivered to their cars, are also getting fully ingrained in the ecosystem in Walmart. So Walmart going forward would look a lot more like Amazon. Is obviously the stock is not priced that way. And that's why we feel like there's opportunity in Walmart shares as well.
Well, Walmart certainly seen some gains this year, especially with this stock split, which it hasn't done since '99. So it's seeing some momentum there. I know it's kind of really just a changing of the cutting of the pie there, but you do notice some patterns when you see a stock split like that. I want to ask you though, also talk to us about other spaces that investors aren't really kind of paying attention to. Anything on small caps from your perspective?
Sure. As we look, again, large has outperformed small in a historic fashion. And in doing so, it was justified to an extent, right? I mean, small cap has less, less potent balance sheets. They have to access capital markets more frequently. They have more of a need of that as well. And as the cost of capital increased, as rates went from nothing to something last year, then those costs of capital weigh on the valuations of small cap. That makes sense. As we move forward into the latter part of this year, as we move from higher for longer perhaps to a cutting cycle, whether it's early this year, late next year, we really look at small cap as they have a tailwind that's actually coming into the shares. Now, a lot of small cap is unprofitable, but we feel like over 2024 and into 2025, the landscape is set in a way that small cap could benefit from a cost of capital standpoint in a way that large cap doesn't. And the valuations just simply don't reflect that right now. So there are opportunities in small cap. One, again, remain in the profitable parts of the Russell 2000. But we feel like that shift away from all of the attention being on mega cap could potentially benefit some small cap names later into the year.
And what risks are you paying attention to when you think about kind of just this strength in the market, the overall bullishness that we're seeing? What are the risks or the red flags that you're paying attention to?
One of the main risks that we are really paying close attention to is just the top heaviness of the market and how those largest names, especially with the outsized impact on the indices, perform into the year. The risk that AI and NVIDIA in particular, I think, carries this risk. I think that's where we saw some weakness into the report last week, was if there's any inkling of not only this decelerating growth, but just any disappointment on the growth standpoint, those names will have an undue, really dramatic impact on the rest of the market. We saw that kind of early part of 2022. That could come into play again this year, and we don't anticipate that the AI momentum or the growth behind it really blows up by any stretch of imagination. But a slight disappointment could really give a wrinkle into those names that perform extremely well, trigger some profit taking, if you will, and really cascade down in cap and really topple this rally that we've had over the past couple of months. So we're really hanging on to every word that's coming out of the companies that make up such a large part of our indices, particularly in earnings season.
And Keith, final thought on the change in the Dow. We've got Amazon entering the Dow today, Walgreens Boots Alliance coming out due to that split with Walmart, which kind of changes the weighting and the shift. So what's your final thought there?
It's not much to do about nothing, but the Dow doesn't drive many things especially on our side of the investment business to a dramatic extent. I think it's symbolism. Walgreens definitely is a different part of their cycle their life cycle than Amazon is. So that's emblematic of kind of the way those businesses currently lie in the state of those industries that they play in. But we don't think it really affects the prospects for either one of those companies in a way that should affect valuation. The trading could be different over the next couple of weeks, but not anything that's dramatic.
All right, Keith Buchanan, Portfolio Manager, Global Investments. Thank you, Keith.
Thank you.